Good morning. Welcome to Stock Market Today. It is Thursday, February 20th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today, where you can sign up for a free email to follow along with this show, as well as get daily stock ideas to consider. Hits your inbox every trading day before the market opens. So it's good to be back in the saddle. U.S. equities finished higher in Wednesday's trading. Energy was the best performer on strength in crude oil, and technology also outperformed on the back of strength in semiconductors. Defensive sectors lagged on the day. Treasuries were mostly weaker. The dollar was stronger against the yen, but weaker on the euro cross. Gold was up 40 basis points, and WTI was strong, up 2.3%. As we get to the desk this morning, giving a little bit back, futures are down about 10 basis points after the S&P and NASDAQ closed at new record highs yesterday. Asian markets were mixed overnight, but China gained nearly 2%. European markets are weaker here in the early going. Treasuries are stronger with the curve flattening. The dollar is stronger against the major crosses. Gold is up 10 basis points, and WTI crude is higher by about 30 basis points. And as we look at the structure here, the S&P 500, it's been a week since I've been here, but not a ton has changed, right? New highs for the index as the bull market grinds on. We still have support in that range between 3,250 and 3,300. So that's what we're looking at on any pullbacks here in the near term. We're still looking for a resistance level to form, right? The market at all-time highs. By definition, there is not a price-based resistance level. The RSI remains in bullish ranges, but that divergence that we've been talking about does remain in play. At the same time, Chaikin money flow, similar dynamic. It's bullish, but a series of lower highs as the market has moved higher. So also, if you want to call it a divergence in play. What does that mean? It means we just be a little bit more diligent in our ideas, maybe become a little bit more selective with long ideas and adding those to the portfolio. But for all intents and purposes, the trend does remain higher. And from that perspective, we think it makes sense to maintain a bullish stance on the market in general. Turning to our market in a minute, what are we writing about today in our note to Chaikin Analytics clients? Well, stocks rally on Wednesday, led by energy and technology. Breadth is constructive, but there as well, the divergences remain in place. Small caps have not made a new high with the SPY. That's the IWM we're looking at. But small cap growth is a bright spot. We'll take a look at that a little bit later in the show. And as I said, futures do point to a lower open here today. Slightly so, but still a lower open. Looking at the major indices now from a power bar perspective, the Dow added about 40 basis points yesterday, 8 bulls to 6 bears there. S&P 500 tax on 47 basis points, and we're still greater than 2-to-1 bulls to bears, 140 to 61 on that metric. The NASDAQ was up about 1% yesterday. Strong day for tech on the back of semis, as we said, 34-3 bulls to bears in that group. Small caps, Coleman in line to slight outperformer on the day yesterday, 479 to 264 bulls to bears in that group. Bonds ever so slightly lower. Energy was the big leader on the day from a sector perspective, up 1.3%. But look at that power bar ratio is still bearish. Energy looks like it's having a bit of a counter trend rally. Fundamentals there based on Chaikin power gauge ratings still remain bearish. There's 10 bearish or very bearish stocks for only 1 bullish or very bullish stocks within the energy sector. According to the Chaikin power bar, large cap stocks and small cap stocks are bullish. Major markets across the board are somewhat mixed. Let's hit our stock of the day now. Remember, the stock of the day is auto-generated, and it's based on the power gauge rating. And then I take a look at it for you here in real time. Today's stock is Athene Holdings, closed at $49.30, down 1.4% yesterday, comes to us from the insurance group. Athene, ticker ATH, has a very bullish rating due to very attractive financial metrics, very strong earnings performance, strong price volume activity. Does have some negative expert activity, but when we take the 20 factors, 5 in each of these 4 categories, we come out with our very bullish rating. Strong trend here, stock above a rising long-term trend line, strong industry group. From a power bar perspective, insurance is a good area of the market. Now, this is an interesting name here. We have a very bullish rating met with some recent outperformance. Money flow is bullish, but the stock is overbought following this rally. The way I see it is a couple of ways to play it. If you're a breakout trader and you like to trade stocks that break to new highs, you have a clearly defined risk level to shoot against at the $48 mark, right? So the breakthrough $48 is your trigger. As long as we're holding above that level, it looks compelling. On the other hand, if you're following more closely with our process, you're waiting for an oversold condition. What you'd love to see is a consolidation above $48 that works off this overbought condition so that the overbought oversold indicator can get back down towards an oversold reading, at which point it becomes a higher probability idea in our view. Couple of ways to slice Athene today. Either way, it definitely looks like the type of stock you want to own, right? A very bullish stock that's leading the market and part of a strong industry group. It really comes down to timing and your particular style. If you're a breakout trader, it looks interesting. If you want to wait for an oversold condition, we can't argue with that mentality at all. Turning to our sector tracker now, movement of the major sectors over the last 5 days. Utilities at the top of the list, right? Utilities are one of those defensive areas of the market that we've been talking about. Kind of interesting to see the Utes strong here. Com services, another area of the market that we've liked of late, and the number 2 slot, right? That group has really shown some increasing relative strength. And I think it's interesting because the dynamic that we're seeing in the market is similar to what we saw in the first half of 2019, where you have kind of your growth areas of the market, your more offensive areas like tech leading, while defensive areas are also performing well. And I think comm services is an interesting mix of both of those themes. Tech in the number 3 slot, biggest weight in the S&P 500. We like to see that one performing well. Staples, REITs, and discretionary round out the groups that are positive over the last 5 days. Financials, there's no doubt that the decline in yields has weighed on the financials. Healthcare, giving a little back, stalling after a solid rally, both on an absolute and relative basis. Materials and energy at the bottom of the list, along with industrials. So your more cyclical groups underperforming in the near term here over the last 5 days of trading. Turning now to our industry in focus, speaking of financials, the regional bank services group, which over the past 6 months has underperformed the S&P 500 by about 2.4%. Power bar ratio, however, is very strong. 42 bullish stocks for only 12 bearish stocks. It's currently ranked number 6 of 21 subsectors, but it has moved down 2 slots over the past week. That's based on this ratio. Some of the indicative names there: Heartland Financial, HTLF, QRC Holdings, QCR Holdings, QCRH, and UMB Financial, UMBF, all with very bullish Chaikin Power Gauge ratings. If I had to make a call on any of these, I think HTLF Heartland is the one that looks most compelling. But if we look at the group, KRE, it's more nuanced, right? I would say we're kind of not there yet. The decline in rates really weighing on these regional bank stocks. Neutral power gauge ETF rating, but a strong trend above this rising trend line, which has acted as support. 42 to 12 bulls to bears, but we have bearish money flow. And look at the underperformance to start the year, right? Financial started to get going in the October-November timeframe on a relative basis, but at the start of the year, quickly started to underperform again as rates moved lower. That does remain the case. So you have a neutral group that's underperforming with bearish money flow. At the same time, the fund is overbought. So I think you really have to be selective if you're looking for names within this group. At the same time, I think with a solid uptrend for the market, it makes more sense to focus on the areas of the market that are outperforming. Right now, that is not the case for the regional bank group KRE, whether you're looking at the ETF or you're starting to drill down on some of the individual names. I do think at the individual name level, you need to be more selective. Taking a look at what's trending now. Yesterday's S&P 500 movers and shakers are gainers and losers. CXO up 7.5% following their earnings announcement, which beat expectations. Garmin 6.75%. They beat on both EPS and revenues to send that stock higher. Diamondback Energy, FANG, as a bearish rating, was up 6.3% yesterday following their earnings announcement. NVIDIA caught an upgrade, also part of that strong semiconductors group. That helped send NVIDIA higher by a little over 6%. And IPG Photonics didn't see anything on company specific on the news front to send that stock higher by 6% on the day. On the loser side of the board, EXR down 6.8% following their earnings announcement. PSA, REITs were under pressure yesterday, and PSA went along for that ride, down 5.6%. It does have a very bearish rating. VNO, also part of the REIT group, which was under pressure, as I said. They also announced earnings, which took 5% out of the stock. Tyson TSN, didn't see anything company specific there. Name under pressure yesterday, 2.9%. And ConAgra, part of the same group, ConAgra with a very bearish Chaikin Power Gauge rating, down 2.87%, following through, right? Stock was down hard the previous day following their earnings announcement and seeing some follow through to the downside yesterday, taking 2.87% out of the stock on the day. So diving back in now to what our weekly rotation. On Thursdays, we look at market breadth to try to get a sense for the health of the trend, right? And those divergences that we started to call out a couple of weeks ago do remain in place. Looking at the percentage of stocks above in the S&P 500, currently above their respective 200-day moving averages, it's still a healthy majority of stocks, right? 78% of stocks in the group above their 200-day moving averages, right? Above 60 is considered a healthy majority. So we're still seeing a healthy majority, but it's interesting that the new highs in the S&P 500 are not being met with new highs by this metric. That's the divergence that we're talking about. The same can be said in the intermediate time frame, right? The percentage of stocks above their 50-day moving averages down in the mid 60s. So again, still a healthy majority, but that divergence is in play, a lower high as the index makes a higher high. And if we drill down even further and take it to the short term time frame, if I look at the percentage of stocks currently trading above their 20-day moving averages, that's in the mid 60s as well, down from the low 70s last week. And again, that divergence is in place. So what does that mean? Do we kind of run out and sell everything? No. Again, similar to the RSI divergence, it's something we want to be aware of. It's something that should make us more selective with adding new ideas to the portfolio, right? It's not an outright sell signal. These divergences can work themselves off through time. But for me as well, if I look within Chaikin Analytics at the SPY, the Qs, the IWM, they're all overbought on that short-term overbought, oversold metric that we use. So to me, that calls for, number one, sticking with what you have, managing your risk, right? If you have an opportunity to move your stops up, you want to move your stops. And if you're thinking about adding new ideas to the portfolio, I think it makes sense to be a little bit more selective here in the near term. Wait for the markets to work off those overbought conditions, see if we can get these divergences to resolve back to the upside. And then it makes sense to become more aggressive with adding new names to the portfolio, right? There's not a rule out there that says you have to trade every day. Sometimes, the best course of action is to stick with what you have, manage your risk, build out watch lists of leading stocks and leading areas of the market, so that you're ready when that opportunity does present itself, right? One of the areas of the market where we've been talking a lot lately because of its underperformance is small caps, and they continue to lag the SPY. Here's the IWM on an absolute basis consolidating, and what should immediately jump out is that while the S&P 500 is trading at new highs, small caps are not. They're continuing to consolidate below their early 2020 highs. So that's one dynamic that's in play. At the same time, if we take a look at the RSI for the fund, right, we're kind of stuck in the middle of the range here as we consolidate, right? No real momentum one way or the other during this near-term consolidation. But for us, the key is the underperformance, right? When we want to focus on leading areas of the market, right, it's your large caps and your mega caps that are outperforming. If we look at IWM relative to SPY, we can see a steady downtrend continuing to be in place on a relative basis. So if we're thinking about where to skew your ideas, I think you want to skew your ideas towards the large caps and the mega caps within the marketplace, less so to the small caps. However, if you are inclined to be looking at the small cap growth is a bright spot. IWO, the iShares Russell 2000 Growth ETF, has a bullish ETF power gauge rating, 235 to 172 bulls to bears. This one did trade at a new high yesterday. Similar divergence, but it is outperforming. So if you are looking for ideas in small cap, I think it makes sense to skew to the growth side of the spectrum. So that's going to wrap us up for today. Head over to ChaikinAnalytics.com/test drive to sign up for a free 14-day trial to Chaikin Analytics. I'll be back here tomorrow.
Missed the live show? Want to rewatch a workshop? Tune into the StockCharts TV YouTube channel to catch up on the latest programming and content. All of our live shows, workshops, special guests, and more can be found there. Each category has its own playlist, so it's easy to locate. We even have Chart School and creative strategy videos to help you become a better technical trader. Leave comments for our commentators, like your favorite videos, and don't forget to subscribe to our YouTube channel.